What's going on, everyone? So let's get into this stock today. Now, what stock I'm going to be looking at? Well, first you need to know why I am building this stock portfolio.
Retirement accounts have age restrictions, so in most cases, you gotta wait till 59 and a half to tap into those 401ks and IRAs without penalties. So here's a bonus.
Because everything should have a reason when you invest. This stock portfolio is for my bridge account.
So you think, okay, I want to retire early. I want to leave the workforce before 65. Maybe I want to leave at 55 or maybe even 50. You better understand how you're going to pay for your living expenses at that time, because we know 401ks, I can't get to that money if I leave before 55 till 59 and a half. IRAs, can't get to it till 59 and a half. So you need to understand how you're going to bridge that gap. Well, one of the best ways to bridge that gap is an after-tax account. So having an after-tax bucket, what it's really going to provide is flexibility later in life. And that's all we're trying to do, is give ourselves flexibility so that we can choose how we want our financial life to look.
I'm trying to build a bridge account because my 401k is going to end up costing me more when I retire than if I just did a bridge account and maximize my Roth. Now, at the end of the day, everyone should talk to a financial advisor to find out what's best for you and how to invest. Well, since this is going to my bridge account, I want it to be a passive income. Now, if you don't know what passive income is, here's a short clip.
Think that passive income exists. I think the reason so many scum buckets are making so much money is because you're buying stupid courses over and over, thinking there's some magic formula for passive income. Passive income looks like this. You take money that you can afford to go to zero and you put them into two places that have historically created passive income. Public markets that you don't care if it goes up and down and you just wait to the end, or real estate, and you hope that your real estate area doesn't get crushed. Everything else almost doesn't exist.
Now, at the end of the day, I have to invest my money. I came up with a strategy that works for me and might not work for you. I'm looking for these three requirements for my dividend paying stocks. One, it has to pay dividend. Two, it has to be.
Never buy a stock that doesn't pay a dividend. That has been your advice through and through. Why are these stocks more attractive?
You look at companies that don't pay distributions, don't return capital, how risky they are. Take a GoPro, for example. I'm not just picking one company. I'm just giving you a good example of a company that basically has lost 70% of its value, never returned a dime to shareholders. Or how about a company
in good financial standing? And three, it has to have good growth opportunity, because I have some time before I actually can retire. So guess what? I don't need that money right now. So I want to capitalize on the growth, but also I wanted to pay a dividend. Now, Warren Buffett is the one that made me read The Intelligent Investor, and this is what he has to say.
Thing was to predict what a stock would do and predict the stock market. And then I read Ben Graham, when I was 19 or 20. And I realized that I was doing it exactly the wrong way. But it didn't hurt that I had that background and everything. I rejiggered my mind and when I read the book, The Intelligent Investor. And from that point, I never bought another stock. I bought businesses that happened to be publicly traded.
And this is the stock we're going to get into. We're going to get into the UPS. And they've been around forever. If you don't know what UPS, they're a delivery company that deal with logistics. And they're a pretty decent company for a delivery company. Now, they're not the best, they're not the worst, but they're pretty good on delivering your stuff. Now, that's UPS. If you need to know more about them, you might have to look them up. I'm not going to waste too much time on them. They're United States Postal Service, and they deliver packages for you. Now, let's look at what the USPS, or ticker symbol UPS, or United Parcel Service, what have they been doing on their stock? So year to date, they're negative 30%. 1 year, they're negative 39.98%. 3 years, they're down negative 55.40. And 5 years, they're negative 74.92. And overall, they're up 32.36 since they've been incepted or been around. Kind of surprised I didn't think UPS was going to be tanking that bad. And they've been tanking a good part, it looks like 2021, and haven't been recovering. But before all that, let's look at the dividend, see what they've been doing for the dividends. Well, they pay a pretty good dividend yield, 7.5%, but it doesn't help that they lose 20-30%. Annual dividend is about $6.56, and they've been growing dividend for about 15 years. So yes, they're very good at paying dividends, but you're going to lose value if you purchase it, because 7.5 and 1 year of 31, you're losing a good 20% or 17%, something like that. So you're losing a good portion of your money. You're losing 17% every year. But let's look at the finance, see what's going on. Okay, they've been growing. The revenue per year been growing. Since 2022, they've been dropping, and they look like they're on the increase. Let's see what the gross margin is. See, they have a good gross margin, 80.28%, but the net profit is 6.35%. That's kind of low. I'm not sure why they're that low. I think they need some restructuring at this point, because net profit is not that good. Let's look at the balance sheet. I really like using the balance sheet to see how much money how much assets, and if they're worth it. So fixed asset 50, 69, and they owe current liability about 35 billion. So they're worth more than they're worth more than what they're liable for. So that's a good thing. That's why I look at that. And then I like to look at the cash flow, see how well they've been doing on the cash flow. Operation cash flow, they've been pretty stable. They did decrease it. So investment cash flow, okay, negative 217 million. And the biggest part I like to look at is free cash flow. How much they end up in their bank account at the end of the year? 6.21 billion from 5.08 billion. But in 2022, they were at 9.34 billion. They could have made a big capital purchase or something like that to affect it, like vehicles or anything. But it looks like their free cash flow is pretty decent. And it looks like their revenue has been pretty stable. So why is the stock not still decreasing? I have no idea. This is people selling and buying the stocks. Let's go to what investors are in here. Vanguard, BlackRock, State Street. Okay, the big. All right. What does the analyst say to do? They say buy it. And then earning per share, it looks like they missed some and then they get it on other dates. So it looks like they're a pretty decent company. Now let's go into AI and see what it really thinks. The valuation due to AI is 4 out of 6. Price to earnings versus peer average. Peer average is 14.83, and it's just slightly below that. So that makes sense. FedEx is below that. Expedia International Washington's above that. So UPS that's not bad. Earnings. So this is the EPS growth versus shares. So the earnings, the earnings don't look very well. Compared to FedEx at 12%, USPS is at negative 13.41 for their shares. So that's not good. And the future growth, the future growth is nowhere. Historical performance, compared to everyone else, hasn't been doing very well. But the financial health is good. I agree with that part. Financial health is good. Now, what do I think about USPS or UPS? I don't think I'm going to be adding it to my portfolio. The future growth of it is not there. The earning is not there. But the financial health is there. So financially, they're a very stable company. So I don't see them going anywhere. I think they're still decreasing in value until they figure everything out. But it just has no future growth for me. So I require to have future growth. Now they do pay a good dividend of a 7.19 or 7% dividend yield. So they pay a good dividend. I just can't have them because the growth isn't there. It's actually negative growth every year. So I'll be losing money. Maybe in the next year or two, they start recovering and I'll purchase them. But right now, they look like they're still on the decline. Once they go back on the incline, I'll purchase them. This is the thing about stock. It's a continuous thing you go and look at. Right now, it doesn't look like it's good because the growth is terrible. But you're always supposed to buy it on the down so you can make more money in the future. But until they figure out why the price point is going down, I can't purchase them. So right now, I don't think the growth of this company is there. I don't think the historic performance is going to impress me. And then the earnings isn't that good. So with those things against it, I really can't purchase them. Financial health wise, yes, it's good. But everything else is not there. The valuation is good on this stock. So it's a good time if you're looking for value stock. But at the end of the day, talk to a financial advisor, see if this would be a good stock to add for you. Because for me, it's not a good stock to add to my portfolio. And like, subscribe to my